Vanguard have a suite of products called LifeStrategy funds, which just seem too good to be true. Firstly, the ongoing charge for the funds is just 0.22% per year. That's extremely competitive. They're also multi-asset funds, which means that they're diversified across asset classes, but also globally diversified across the US, Europe, and Asia. So that means the overall volatility of the funds is extremely low for the return you get. So they're diversified and they're cheap. Another bonus is that if you hold it directly with Vanguard, they just charge you 0.15% per year to hold the fund. That's very competitive compared to other platforms. But of course, as with any investment, there are drawbacks and there are risks. So let's look at those now in a little bit more detail. Remember, this is not a recommendation. If you want financial advice tailored to your financial circumstances, seek independent financial advice. Firstly, let's recap what we mean by risk and return. If your investment is low risk, that guarantees that you will have a low return. Investing in something which has high risk does not guarantee a high return, because it also comes with a risk of high loss. For example, if we put cash into the bank and the sum is less than £85,000, that's guaranteed. But once we consider inflation, that will generate a negative return. In other words, your cash is losing value over time. But if we invest in something higher risk, like the FTSE 100, then the typical annual move of the FTSE is 20% either up or down. But the payoff for taking that risk is that over the very long term, prices tend to drift upwards. So the potential upside is much larger for this higher risk. So if you ride the ups and downs, the average return of the FTSE would have been 7.6% over the last 30 years. But it certainly wasn't a smooth ride. So based on that, let's calibrate our risk and return expectations. At the moment, for an extremely safe cash deposit, we'd expect a negative rate of return once we account for inflation. If we're willing to take some risk on the stock market, we might expect a long-term return of around 8%. And the only way to get more than 10% long-term returns is to take very large risk. Bearing that in mind, let's now look at the Vanguard LifeStrategy suite of funds. They offer 5 funds according to your risk appetite. That's how much risk you're willing to take. Vanguard also consider your investment horizon. If you only have 3 to 5 years to invest, they recommend taking one of the low-risk options. If you have a moderate willingness to take risk, and you're willing to take that risk over 5 or more years, then you'd go for their mid-risk funds. And if you take the highest risk category, you should be willing to invest for more than 10 years. And here's how the funds slot into those categories. The primary way to increase the risk in your portfolio is to add more shares. So the least risky Vanguard fund is the one with least shares in it. That's the 20% equity fund. Only a fifth of your money will be invested in shares. The rest will be in much safer bonds. As we dial up the risk, we add more shares. So the 40% equity fund has an increased volatility because of those shares. But because it has more equity, it has more potential upside. Then we go to 60% equity, 80% equity, and 100% equity is the most risky fund of all. If you're a nerd like me and you played Doom as a young kid, then this is kind of like the skill levels. If you're new to the game and you're scared, you go for the I'm too young to die mode. Then we go to Hey Not Too Rough, Hurt Me Plenty, Ultraviolence, and the highest risk portfolio would be Nightmare. Let's look at the costs, the size, and the volatility or risk of each of those funds. The right-hand column is volatility as a percentage. That's the typical annual move in the price of the fund. You can see that for the 20% equity fund, in a typical year, it will only move up or down by 4%. And then as we add more equity, the volatility increases. But even for the highest risk fund, the 100% equity fund, the volatility is only 13%. The volatility of a typical stock index is around 20%. So you can see that the diversification has reduced that risk. If we look at the total assets in millions of pounds, you can see that the 60% equity fund is the most popular. That has 2.5 billion in assets under management. And the expense ratio, which is the ongoing charge of the funds, is the same for all 5, 0.22%. To make sense of that, a total expense ratio of 0.22% on an investment of £10,000 would cost just £22 per year. Another thing you have to consider is the cost of holding the fund once you buy it on some platform. The calculation on the left is taken from the Vanguard website. They show that the account fee is just 0.15% per year. You could easily pay 5 times more in account fee on other platforms. So this combined offering offers a very cost-effective way of investing in life strategy funds. We've done another video which talks about Vanguard Direct in detail. If you invest in robo-funds like Nutmeg, you'll be familiar with this idea of graded risk. In fact, Nutmeg has 10 different portfolios graded according to risk. Vanguard is completely transparent about what's inside each portfolio, and the allocations are fixed over time. That means they never change. Here we can see how they diversify within each asset class. So for example, within bonds, they have a global allocation, but also some UK inflation-linked bonds whose value rises with the rate of inflation, also some corporate bonds which boost the returns by taking some credit risk, and extremely safe UK government bonds. And the share component is also diversified in the UK, global markets, and also a small allocation to emerging markets. Because emerging markets tend to be more risky, but they also have potentially greater upside during a strong market rally. The allocations are all to Vanguard funds, so each row in this table is one of the funds to which Vanguard allocates. Now what really stands out is the very heavy weighting for North American equities, that's US stocks. So for the 100% equity fund, almost half of your money, 44%, will be invested in US stocks. The reason for that is that the US stock market is so large and so liquid. But you should be aware of that concentration risk within US stocks, particularly if you think there's going to be a correction in the US stock market. One of the reasons for the popularity of these funds is that they've performed extremely well. Over the 7 years for which we have data, the 100% equity fund has performed best. But that's largely because of its allocation to US stocks. For that reason, I've shown the pink line, which is the performance of the US stock market as measured by the S&P 500 index. That has a much higher volatility than the life strategy funds, but it also has a larger return during this extremely strong rally. This is a plot of risk and return. So you can see that the S&P 500 has the highest return, but it also has the highest risk. The Vanguard 100 fund also has a high volatility, but less than the S&P 500, and the return is also a little bit lower, and so on until we get down to the Vanguard 20% fund, which has an extremely low volatility, but also a fairly low return relative to the other funds. So here you can see the trade-off between risk and return. And so we come to the problems. The first issue is that the life strategy funds haven't existed for very long. Typically a business cycle is a decade, and the purple arrow shows the period of time for which we have data. That only goes back to June 2011, and over that period the S&P 500, the US stock index, has had a very strong rally after the financial crisis. On average, it's given 11.1% every year since 2011. But what I've tried to highlight on this plot are these high watermarks. It's as if these were peaks on a cliff, and the blue regions are where the index fell below its previous peak. And you can see those periods lasted for a very long time. So during the oil crisis in the 1970s, there was a period of 5 years when the S&P didn't reach its previous peak. Then we saw it again after the dot-com bubble burst, and another period of 5 years after the global financial crisis. So this will happen again. There will be another correction in the US stock market, and there will be a prolonged period during which the S&P doesn't reach its previous peak. And because of its very high US allocation, the life strategy funds, particularly the high equity ones, will suffer. So if we can't expect 11% returns in the future, what kind of long-term return should we expect? Fortunately, Robert Shiller has a very long time series for the US stock market. He's extended the S&P 500, which is a US stock market index, back to 1871. Now, over that kind of time period, you do have to consider inflation, because that erodes the value of investments. So this is a real return we'll consider. We've taken away the effect of inflation. Dividends are also very important to income. One of the benefits of owning stocks is that you're paid a dividend, which is a proportion of the profit generated by the company. And over long periods of time, that can accumulate, so that the return we consider assumes you're reinvesting your dividends back into the S&P 500. And the time period we'll consider for the US is 146 years. And over that period of time, you would have got a little bit less than 7% in real terms, which is considerably lower than the 11% we've seen during the lifetime of the LifeStrategy funds. So it would be very optimistic to expect 11% for a very long time period. That return is unusually high when we compare it with history. Another big risk is you. If you buy one of the high equity funds, it will be a roller coaster. Just look at the annual returns on the S&P 500. Although the long-term returns are good, it's not a comfortable ride. It will be extremely scary. During the global financial crisis, you can see that the S&P 500 fell by 50%. That's very scary. Humans have inbuilt behavioral flaws, and in particular, we time trades very badly. We get out too late during a fall in the stock market, and we get on board too late when the rally starts to occur. Putting your capital at risk is just like riding a roller coaster. You have to have courage, and you have to stay in that seat. Now, if you have a financial advisor, or if you invest with Nutmeg, one of the primary benefits they offer is almost like a counseling service. They'll make sure you stay strapped into the roller coaster even during the downs, and also that you don't take too much risk during the ups. But life strategies give you flexibility. They take off the mittens. So there's a risk you'll sell during the downs and buy during the ups. And if, like most of us, you time it badly, that'll be a drag on your returns. In behavioral finance, we'd warn against overconfidence. Nutmeg puts it very well. They say that if an investor picks a stock which then performs well, they're more likely to think they're skilled at investing rather than chalking it up to external factors. Once you think you're Gordon Gekko, you'll overtrade, and men tend to be more overconfident than women. So the general advice is to find a level of risk you're happy with long term and stick with it. Do as little tinkering with your portfolio as possible. Another drawback with LifeStrategy funds is that they're really simple. As markets crash, what would you do? Would you increase your risk by buying more shares and selling the assets which are doing well, which are bonds? Or would you decrease your risk by selling your risky assets, which are the shares, and buying safe assets like government bonds? LifeStrategy funds have a fixed allocation. That means that when share prices go down and bond prices go up in a crisis, LifeStrategy funds would have to rebalance. That means they'd have to buy shares as they fall and sell bonds as they rise. In other words, they'd be dialing up the risk in a crisis. On the other hand, a risk-based allocation strategy, in the same scenario, would reduce risk. They'd sell shares to reduce the overall volatility of your portfolio, and they'd be buying low volatility bonds. And research shows that over the long term, these risk-based strategies outperform fixed allocation strategies. Sometimes, too much simplicity can hurt you. Scalable Capital is an example of a robo-fund which uses this risk-based strategy for investment. But the management fee you pay for that expertise is almost 5 times what you pay for Vanguard. What's your experience with Vanguard LifeStrategy funds? Perhaps it was recommended to you by your IFA. Are you concerned about their very high exposure to US equity? And what do you think would happen in a downturn? We'd love to know what you think. And you can work with us. You can book one of the courses on our website. And if you want to catch all of our videos, then why not subscribe to our YouTube channel?